Good day everyone, welcome to the Value Machine channel. My name is Tamer and today I'm going to talk about two stocks that I'm looking at right now, and those two stocks I might start buying them in this bear market. Before I start discussing those stocks, please do not take this video as a recommendation or a tip. With that being said, let's begin. The first stock that I'm looking at is Alphabet. Alphabet is a tech holding company and it's the parent company of Google. Looking at the structure of Alphabet, we can see that the company has a lot of platforms and companies underneath it. And we can divide this structure into two main segments. The first one is Google, which is the heart of the company. In this segment, you can find ads, Google Chrome, Google Play, YouTube, and more. And the second segment is called Other Bets. In this Other Bets, Google actually holds companies that they invested in or companies that they have started. In this segment, you can find companies like Waymo, the self-driving car project for Google, and beside that, you can find many more companies. Looking at the revenues of those segments, we can see that the Google segment is huge. In 2019, Google brought $160 billion only from the Google segment, and from the Other Bets segment, it only got $659 million. With those huge amounts of money mentioned in the Google segment, there are two operations that are growing really fast in Google. The first one is Google Cloud. Google Cloud doubled its revenue from 2017 from $4 billion reaching $9 billion in 2019. But still, with all of that increase, the revenue is still represents only 5.5% of the total revenue of 2019. The second engine is YouTube ads. YouTube ads revenue grown from $8 billion in 2017 to almost double in 2019, reaching $15 billion. With that also being said, this revenue resembles only 10% of the total revenue of Alphabet. And of course, we can take into account companies like Waymo under the Other Bet segment, but those companies are long shots that might transform at some point into huge companies and bring billions of dollars for Alphabet, but for now, we will keep them as they are, long shots, and we will see what will happen in the future about them. So talking about revenues, let's understand how actually Google makes money. So there's something called AdWords. So let's talk about this AdWords thing. So whenever you're logged into your Gmail account, Google Maps, or any other platform powered by Google, featured and recommended websites that shown over there are generated by something called AdWords platform. In order for those websites to show up on Google's platforms, they need to go into a bidding war with each other. The highest bidder gets the spot on the top of the list and will be shown first, and the lowest bidder might not be shown at all. And each time a person comes and clicks on this website, Google gets paid for it. This click could range from a few cents to $50, depends on the competitiveness of the search term. And now there's something called AdSense. It's kind of the same thing like AdWords, but it just doesn't show on Google's websites. Meaning that other website owners can actually put this AdSense platform on their website and generate money by people clicking on the ads that they are shown on their website. On that click by users like me and you who just go surf the internet, both Google and the website owner makes money. So now that we understood how AdWords work, we can also assume actually that Google needs to maintain its traffic on its own websites. And for that, Google is willing to pay a lot of money. By saying a lot of money, I mean billions of dollars. Only 2 years ago, Google has paid Apple $12 billion to remain Safari's default search engine in 2019. That spending is called TAC, or Traffic Acquisition Cost. So now that we understood how Google makes money, let's take a look at the moat. Just by looking at this picture, we can see that for June 2019, Google and YouTube were the most visited websites with 60 billion and 24 billion visits respectively. From that picture, we can see that Google is the internet. It rules almost everything. And for a new company to come up with what Google came up and to make this much traffic on its own website or related websites like YouTube, it's gonna be really hard. With that being said, we can conclude that Google's moat is well preserved. So now, after we understood how the company makes money, let's take a look at something really important, and it's the actual money that the company brings in from its operations. So let's first talk about the revenues. As I said before, revenues for 2019 were 160 billion, but what I didn't say is that those revenue grew by 18% from 2018. For a company with the size of Alphabet to grow its revenue by 18%, it's something really spectacular. But again, those revenue will not grow from now until Judgment Day. But what will happen is that the earnings per share will start growing, they might start buying shares, and with that actually the earnings per share will start rising because they will reduce the share count. Looking at this table over here, we can see that everything in Google actually doubled itself, whether it's sales that went up from $65 billion to $161 billion in 2019, gross income that went from $40 billion to reached almost $90 billion in 2019, EBITDA the same thing, net income also the same thing, and cash flows grown from $22 billion and reaching $54 billion for 2019. Also, we can see that really nicely in this chart, and from that we can assume that Alphabet's condition in terms of sales, cash flows, net income is really good, and this company will continue growing as I said before. It will do it, of course, slower than it did before, but it will be enough. Finally, let's take a look at Alphabet's balance sheet. Looking at the balance sheet, we can see that Alphabet holds $120 billion in cash for 2019, for the last quarter of 2019. And if we're talking about debt, the company only holds $4.5 billion in long-term debt. So now let's talk about the second stock. The second stock is called Ollie Bargain Outlet. Let's talk about what is Ollie and what are the segments of this company. Ollie is an off-price chain store. In their stores, you can find products ranging from food to electronics, toys, whatever you think of, they have in their stores. Americans love treasure hunt, and Ollie provides that. Ollie's plan is to open more than 950 stores across the US. And with the company having 350 stores right now, it means that it has a lot of room to grow. Ollie's team work in a way that I love. They check wholesalers, brokers, retailers, and more for merchandise so they can bring bargains for their customers. Doing this means that the company might show its customers or surprise them with new inventory and new products. And if those products are really attractive, they will fly away from the shelves really fast. Let's take a look at sales, EBITDA, net income, and more. Looking at the sales figures for Ollie, we can see that the company grew its revenue from $638 million in 2014, reaching $1.2 billion for 2018. Cash flows also grew steadily, but earnings took a hit. And that was because of the tax cuts that Trump administration passed in 2018. But there is something that we should know too. In 2019, earnings took a hit too. And among other things, it was because of the freight costs. There were more store openings and they had a problem with understaffing, which led to more expenses because they had to increase the staff. But they kind of calmed investors in the earnings call for the third quarter of 2019, and they said that all of those issues will be resolved in 2020. They said 2020, but from what's going on in the economy right now, we can also assume that the company will take a hit this year too. Another thing that's important that's taking a hit in Ollie is the comparable sales stores. Comparable sales for the company on average are around 4%. This figure has been declining for the company over the past 2 quarters. The reason for that will be taken from an answer given by the company's CEO on the earnings call for the third quarter of 2019.
Comp sales were in line with our expectations, decreasing 1.4% compared to a 4.6% increase in the prior year. As we stated on our last call, the outsized cannibalization impact of the TRU sites and the record performance of our new stores entering the comp base are expected to remain headwinds through the remainder of this year. However, our long-term growth algorithm remains the same. Merchandise margin rebounded and we regained efficiency levels at our distribution centers.
Now let's take a look how the company will grow. The first way for Ollie to grow is to grow its store count. New stores are proving to be successful, which means that the company could just copy and paste its model from state to state, and that's how it could grow and become a great success. And as said before, the company's plan is to open more than 950 stores. With that being said, and with the company having only 350 stores right now, it means that the company only completed a third of its expansion program. I want to read the part of the 10K where they are talking about the model of growing their stores. And by reading this, you will see how efficient and easy it is for them to grow their store count. And it goes something like this. Our strong unit growth is supported by our predictable and compelling new store model. We target a store size between 25,000 to 35,000 square feet and an average initial cash investment of approximately $1 million, which includes store fixtures and equipment, store level and distribution center inventory, and pre-opening expenses. With our relatively low investment costs and strong new store opening performance, we target new store sales of approximately $3.9 million. New stores opened from 2013 to 2017 have generated an average of $4.2 million in net sales in their first full year of operations and produced an average payback period of approximately 2 years. This paragraph shows us that it's really easy for Ollie to open a new store. An initial investment of $1 million, and there the store is opened. So stores that they opened from 2013 until 2017, made on average $4.2 million in their first full year of operations. And if you think about it, that's an amazing for a company like Ollie. Ollie want to expand really fast, and that's a perfect model, I think, for them to do that. With that being said, this model might be a little problematic because it's easy, as we can see, for them to open new stores. We don't want them to get too greedy and start expanding really fast. If they do start expanding really fast, it might be a problem for them because they might be short on cash, and when a turmoil like this hits the markets or the economy, then they might have a little problem. So by this part, I want to conclude and say that this is it for today. Please, again, don't take this video as a recommendation. That's only my thoughts shown over here, and it's a part of the research that I'm doing about these companies. I hope you liked it, and don't forget to follow me on Instagram. There I post daily and I have daily updates about what's going on in the markets. So I'm gonna see you in the next video. If you have any comment or any suggestion, please leave it in the comment section below. Again, have a great day, and we'll see you soon.